At 8 o'clock in the morning of Friday, August 20, 1982, the Mexican finance minister Jesus Silva Herzog placed 3 phone calls from Mexico City. The first went to Federal Reserve Chairman Paul Volcker in Washington, the second to United States Treasury Secretary Donald Regan, the third to Jacques de Larosière, the managing director of the International Monetary Fund. The message was the same in all 3 calls. Mexico could no longer service its debt. The debt totaled $80 billion, the largest sovereign obligation any country had ever threatened to default on in modern financial history. The loans were denominated primarily in US dollars. The interest payments had been climbing for 3 years as American interest rates rose to historic highs. The Bank of Mexico's liquid reserves had fallen below $200 million. The country was losing $100 million a day. There was nothing left to pay with. What Silva Herzog was announcing was not merely a Mexican emergency, it was an American one. The 9 largest money center banks in the United States, Citicorp, Bank of America, Chase Manhattan, Manufacturers Hanover, and their peers, held Latin American loans equal to 176% of their total capital. Their combined exposure to all developing country debt was nearly 290% of capital. Put plainly, if Mexico defaulted, several of the largest banks in the United States were insolvent, not theoretically, not on paper, insolvent. The phone calls Silva Herzog made that morning triggered the most dangerous banking crisis the American financial system had faced since the Great Depression, and almost nobody saw it coming. To understand how Mexico owed $80 billion to foreign banks in 1982, you have to understand what happened in global financial markets after 1973. The oil shock of October 1973, when OPEC cut production and quadrupled prices, flooded the world's largest banks with an extraordinary surplus of capital. The oil-exporting nations of the Middle East deposited their suddenly vast revenues in Western financial institutions. These deposits, called petrodollars, needed somewhere to go. Lending them back to sovereign governments in the developing world seemed like a safe and profitable answer. Logic was compelling, and at the time, widely accepted. Governments, unlike corporations, could not go bankrupt. That was the conventional wisdom. A sovereign borrower backed by a national economy and a central bank would always find some way to service its debt. The banks lent aggressively. Between 1973 and 1981, the volume of private bank loans to Mexico alone multiplied by 6. Latin America's total external debt grew from $75 billion in 1975 to over $315 billion by 1983. Mexico was at the center of this lending boom, and for reasons that at the time seemed to justify the confidence. In 1977, a massive oil field discovery, the Cantarell Field in the Gulf of Mexico, transformed Mexico's fiscal outlook overnight. The country was sitting on enormous proven oil reserves. It could borrow against future oil revenues, use the proceeds to develop its economy, and repay the loans from the oil income that was going to keep flowing. The loans came, the oil revenues came, and then 2 things happened simultaneously that the entire financial architecture of the decade had failed to anticipate. Before we go further, if this kind of history matters to you, consider subscribing to the channel. Every video here is built around the financial decisions that actually changed the world, the crises, the policy failures, the moments when the system revealed what it was designed to protect. If that is the kind of analysis you want to keep watching, the subscribe button is how you tell us. And we want to hear from you. Did you live through one of these turning points? The 2008 collapse, the 70s oil shock, the end of Bretton Woods? Did it change your family's circumstances, your understanding of how money actually works? Leave it in the comments. The most complete record of these events is not in any official report. It is in the people who were paying attention. Now, back to the account. The 2 things that happened simultaneously were these. American interest rates went to historic highs, and oil prices collapsed. When, in October 1979, Federal Reserve Chairman Paul Volcker had made a decision that was necessary for the United States and catastrophic for Mexico. American inflation had reached 13%. The Fed's credibility was in question. Volcker chose to break the inflationary spiral by raising interest rates sharply and holding them there until the economy submitted. By 1981, the federal funds rate reached 20%. It was the right medicine for American inflation. It was poison for every borrower who owed dollars to American banks. When Mexico's $80 billion in foreign debt was denominated almost entirely in US dollars. The interest rate on most of these loans was floating. It moved with market rates. When Volcker's rate hike drove American rates to 20%, Mexico's annual interest payments increased by billions of dollars overnight. Revenues that had been calculated at historical interest rates of 8 or 10% were suddenly insufficient to cover payments at rates more than twice as high. Then oil prices collapsed. In 1981, global oil prices began falling sharply from the heights reached during the second oil shock of 1979. By 1982, oil revenues, the primary source of government income that had justified the entire borrowing program, were dramatically lower than any projection had assumed. Mexico was trapped between two forces it had not created and could not control. The price of its primary export was falling. The cost of servicing its dollar debt was rising. The gap between the two was growing larger every month. By February 1982, Mexico was forced to devalue the peso, making its dollar-denominated debt burden larger in domestic currency terms. By August, it was over. The scale of American bank exposure to Latin American sovereign debt in 1982 requires a moment to absorb fully. Capital is the cushion a bank holds against potential losses. If a bank has $1 of capital and makes $1 of loans, its loan-to-capital ratio is 100%. At that ratio, if all its loans failed, the bank would be wiped out precisely. Most prudent banking standards of the era considered a loan-to-capital ratio above 80% to be aggressive. Above 100% was considered dangerous. By 1982, the 9 largest U.S. money center banks had Latin American loans equal to 176% of their capital. Their total exposure to all developing country debt, loans to governments in Latin America, Africa, and Asia, reached 290% of capital, nearly $3 of sovereign debt for every dollar of capital they held. Citicorp alone had Latin American loans exceeding the bank's entire net worth. The same was true of manufacturers Hanover, Continental Illinois, and Bank of America. These were not marginal banks. They were the institutional core of American finance. What made this exposure particularly dangerous was its concentration. The banks had not diversified their sovereign risk across hundreds of small positions. They had accumulated enormous positions in a handful of large countries, Mexico, Brazil, Argentina, Venezuela, whose financial conditions were deteriorating simultaneously. If Mexico fell, Brazil was likely to follow. If Brazil fell, the pressure on Argentina and Venezuela became unbearable. The dominoes were not metaphorical, they were mathematical. Bank regulators had seen the numbers. The Federal Deposit Insurance Corporation had warned that the LDC lending was excessive. These warnings had been largely ignored. The lending was highly profitable. The sovereign borrowers had never defaulted on modern loans at scale, and the pressure from bank management and shareholders to maintain the earnings was intense. The warnings went unheeded, the position built, and when Mexico called on August 20, the exposure that had been accumulating for a decade became in an instant a systemic threat. The 90-day moratorium Mexico announced on August 20 was a request, not a solution. It bought time. It did not buy confidence. Within days, the consequences of Mexico's announcement began cascading through the global financial system. Most commercial banks immediately reduced or halted new lending to Latin America. Mexico's outstanding short-term loans, credit lines that had been routinely rolled over every few weeks, were suddenly not being renewed. Billions of dollars of short-term debt that had functioned as a permanent revolving credit facility were now coming due immediately. This accelerated the crisis rather than containing it. A country that might have survived if its short-term debts kept rolling over was now facing demands for immediate repayment on top of the long-term debt it had already declared it could not service. 1. The peso collapsed. Capital fled the country. Mexican businesses and wealthy individuals who could access foreign exchange moved their money out of Mexico as fast as the banking system would process. By August 14, the government imposed capital controls, restrictions on converting pesos to dollars, attempting to stop the outflow. The controls slowed the bleeding. They did not stop it. On August 31, 1982, Mexican President José López Portillo made a decision that shocked the financial world. He announced the nationalization of Mexico's private banks. The government would take control of the country's banking system. The banks that had facilitated the capital flight, in the president's framing, the banks that had been used as instruments of speculation against the peso, would now belong to the state. Within that nationalization solved nothing structurally. It did not reduce Mexico's debt. It did not raise oil prices. It did not lower American interest rates. What it did was demonstrate, with unmistakable clarity, the political consequences of a financial crisis that had been allowed to reach the acute stage before anyone intervened. On September 7th, bank runs broke out at American branches of Mexican banks. The day became known as Black Tuesday. The rescue of the American banking system from the consequences of Mexico's default was one of the most consequential financial operations in post-war history, and it was conducted in a way that was never fully explained to the American public. The immediate problem was this: if Citicorp, Bank of America, manufacturers Hanover, and their peers were forced to acknowledge that their Latin American loans were impaired, that the sovereign debts would not be repaid in full or on time, those banks would have to write down the value of those loans. Writing down loans at 290% of capital would have made the banks technically insolvent. Technically insolvent meant regulators were obligated to intervene. Regulatory intervention meant acknowledging publicly that the largest banks in the United States did not have enough capital to absorb the losses they had already sustained. This could not be allowed to happen. Not because the banks were too important to fail in any abstract sense, but because the immediate consequence of publicly acknowledging their insolvency would have been a bank run on every major American financial institution simultaneously. The Federal Deposit Insurance Corporation did not have the resources to cover deposits at institutions of this scale. The solution Volcker and the regulatory authorities devised was elegant in its institutional construction and ruthless in its application. The banks would not be required to mark their Latin American loans to market. Instead, regulators would forbear. They would allow the banks to carry the loans at full face value on their books while the crisis was worked out. In the Fed's formal language, the loans should not be subject to supervisory criticism. The bank's stated capital positions would not reflect the actual impairment. Simultaneously, the IMF under de la Rosière assembled an emergency package. In December 1982, the fund announced a program worth $3.75 billion for Mexico, conditional on severe structural adjustment measures, budget cuts, peso devaluation, privatization, and a fundamental reorientation of the Mexican economy away from state-led development. The banks that had lent recklessly were not required to absorb losses commensurate with their recklessness. The IMF loan ensured Mexico could pay interest, not principal, just interest, keeping the loans technically current on bank balance sheets. The public funds went to protect private bank balance sheets. Mexico received debt restructuring. The banks received regulatory forbearance and an institutional backstop. It was a rescue. The word used at the time was adjustment. For Mexico and for Latin America broadly, the decade that followed August 1982 became known simply as the lost decade. Mexico's GDP per capita, which had grown at 3.3% per year between 1960 and 1982, averaged just 0.7% annually for the next 3 decades. The years of growth that had justified the borrowing were not just interrupted, they were structurally broken. By 1989, Mexico's economy was 11% smaller than it had been in 1981. The debt as a proportion of GDP doubled from 30% in 1982 to 60% by 1987, despite the structural adjustment program that was supposed to reduce it. At least 800,000 Mexican workers lost their jobs. Inflation ran into the hundreds of percent. The peso lost the majority of its purchasing power. Ordinary Mexicans who had participated in the growth years of the 1970s found themselves in circumstances dramatically worse by the mid-1980s through no decision of their own. The American banks that had caused the crisis through reckless lending were protected by regulatory forbearance. Their executives were not prosecuted. Their institutions were not restructured in any meaningful way. They earned time and IMF money to gradually build capital against their impaired positions. By the late 1980s, the crisis had been absorbed for the banks. For Mexico, the absorption took a generation. 3 legacies emerged from the 1982 crisis that shaped the architecture of modern sovereign finance. The first was the moral hazard template. Banks lent recklessly to sovereign borrowers, knowing, or at least suspecting, that if the crisis became systemic enough, official intervention would protect them from the worst consequences. The 1982 rescue confirmed that suspicion. Every subsequent sovereign debt crisis, from the Asian crisis of 1997 to the European debt crisis of 2010, has been conducted in the shadow of this template. The second was the IMF conditionality model. The idea that a country in crisis must restructure its economy as a condition of emergency lending, cutting government budgets, privatizing state enterprises, devaluing the currency, became the standard operating procedure for sovereign debt resolution. Whether those conditions helped or worsened the recovery remains one of the most contested questions in development economics. The third legacy is structural. The 1982 crisis revealed that sovereign debt denominated in a foreign currency and carrying floating interest rates is the most dangerous liability any government can hold. When American interest rates rise, developing country borrowers with dollar debt face an instant and proportional deterioration in their ability to pay, regardless of what happens in their own economies. This insight, that the dollar's role as the world's reserve currency gives American monetary policy global consequences that no other country's policy carries, is written into the risk architecture of every sovereign debt transaction today. If this account has given you a clearer understanding of how financial power actually operates, subscribe to the channel. There are more crises, more decisions, more turning points still to document. And if this period of history connects to something you lived through or something a family member witnessed, the bank runs, the inflation, the austerity, the moment a system everyone trusted stopped working, tell us in the comments. What did they see? What did it cost them? What did they believe afterwards? The official version of these events is always written by the institutions that survived them. The fuller version belongs to the people who did not.